Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's going on in investment markets right now. Now, last week we did a real focus on the change in narrative that's been going on in the markets. Now, if you want to know a bit more about what that change is, then go and look at what happened in August, what sectors did well, what types of stocks did well, and compare to what's happened in September. You will notice the winners in August have been the losers in September and vice versa. Now, if we move on just a week in investment markets is a long time, and since that video was made, we've now had central banks start to make decisions. Now, the first one that made a decision was the European Central Bank. Now, Mario Draghi launched QE Infinity, so quantitative easing. That means more money printing. And there was no real end date set to this. So they're going to start printing money again. And interest rates were cut even more into more negative territory. So that's a mass amount of monetary stimulus that they've put into the market. Now, the market didn't react overtly, aggressively in any kind of way. We saw a slight uplift. Everybody was waiting to see what the Federal Reserve in America would do. Well, yesterday we had the Federal Reserve cut interest rates again by 0.25%. Not as much as some people hoped, but also there was no mention of QE, although there is a hint. Jerome Powell in his press conference afterwards did try and drop a hint that QE4 might be coming at some point in the future. But that seemed to be a case of somebody tapped him on the shoulder and said, look, the market's not too happy with what you just announced. Perhaps you need to offer them something to get excited about. But what we saw were interest rates cut, but more importantly, we had some dissent on the panel. So there were some people who wanted rates cut. Had some people who wanted them to be cut even further by as much as 0.5%, but some that didn't want them cut at all. So for the market would describe this as a hawkish interest rate cut. A bizarre term, I know, but the point is they perhaps weren't as dovish as people hoped. Now, the stock market did pull back ever so slightly. It wasn't a massive sell-off or anything drastic, but it just showed that people are now wary of where the central banks are going. Will they continue to support the market? Over in Japan, for example, they decided to sit on their hands and do nothing when the Japanese central bank met this week as well. So we're at an interesting juncture with markets. If you remember last week, we had the bond market was sending a signal. It was starting to strengthen. The yield was rallying. So bonds themselves were weakening, but the yield was strengthening. Now, that was suggesting that people were thinking that the economy was perhaps globally better than they thought. But what we've seen this week is that sell-off has steadied. And although yields did pick up and they moved from about 1.7% up to about 1.9 at their worst this week, they've since pulled back a bit, and that is partly because of what happened with the central banks, but also because the sell-off in bonds was quite aggressive. Perhaps it was overdone, and I think what we're seeing, we've gone from a narrative where people were worried that perhaps in August central banks couldn't do anything, to in September where we felt that central banks might be able to do something, to then suddenly we're back in the realms of, are people worried that central banks might not be able to do enough or prepared to do enough? So bond markets have steadied, and the other thing that helped that was we had some of the worst economic data from China in 17 years. So the industrial production numbers were dire. And now there's a company in America called FedEx, which is basically distributes parcels. Now, obviously, they're a very good bellwether for the US economy. That's because, obviously, you're sending stuff around, and they're a very good indicator of how they foresee the outlook for the US economy. Now, their results were dire, to use that word again. Their share price fell about 13% in one day, and their outlook for their future results was obviously pretty poor. So lots of investment brokers cut their sort of ratings on that particular stock. So that as an indicator, that showed that the economic plight of America perhaps isn't as good as some people are hoping. So that again provided support for bond markets. People started to buy US treasuries again. So has the narrative completely changed? Have we gone from a change in narrative last week and we've gone back to where we were in August? So the things that did well in August are doing well again. We've seen a bit of that in the last couple of days, but it's a bit too early to tell whether we're going to keep that and that's going to be a permanent change back again. Now, the one big story this week, which is a bit of almost a black swan that people didn't expect, was the oil price. Now, The price of oil spiked this week and it rose as much as 20% in a single day. Now the reason for that was because of a drone attack on one of the biggest oil refineries in Saudi Arabia, and it's also one of the biggest in the world. So we had a loss of oil processing, and the impact was that the oil price jumped by 20%. It's been incredibly volatile. Now, Iran has been blamed for that by Saudi Arabia and also Donald Trump himself. So we've also got the possibility of some kind of war that might happen. So forget the trade war this week. We've not had so many headlines around the trade war. We're now looking at perhaps a more real type of war. But the oil price jumped. Now that had a massive impact on energy stocks. So energy stocks, where they will have exposure to the oil price, they rallied. And it threw a real wobbler to markets. They didn't know quite how to react. Now, interestingly, that came on the 11th anniversary of the Lehman Brothers collapse. So if you remember, going back 11 years, that was one of the big moments in the financial crisis that actually triggered markets to head even lower. So it's almost a twist of fate that it happened on the same day. But what it's meant is that with markets now trying to work out what the impact could be on the global economy. So a higher oil price is normally inflationary. That means that the price of lots of things, not just things at the pump that can make plastics go up in price, it causes inflation to pick up the price of lots of goods that we buy. But for companies, it can push up their costs, but also it can, for economies, cause headwinds, because if the cost of things go up, consumers stop spending. I'll give you a good example. India imports a lot of its oil, so if the price of oil goes up, it starts to hit their economy. So at a point where people are worried about the global economy, a spike in the oil price could be problematic and actually drive the global economy perhaps into a recession, even though it might be able to stand on its own 2 feet and make a recovery. So people are worried about it. The question is how long is this oil spike going to last? Now, Saudi Arabia have claimed that the processing output of those refineries will be back up and running soon, so it shouldn't impact the amount of oil that they are able to produce and export. So we'll have to wait and see, because if we have a sustained spike in the oil price, then it could have a global impact on the economy around the world. Now, if the spike in the oil price is short-lived, I think people will breathe a sigh of relief, particularly central bankers, because they've got this issue. If the global economy is slowing, or their own individual economies are slowing, then they will be more likely to cut interest rates. Cutting interest rates tends to cause inflation to pick up. But of course, if you've got the oil price doing the same thing, then they're less likely to want to cut. It depends how long inflation or the impact of this oil price spike lasts, because if it is lengthy and it pushes up inflation, it makes cutting interest rates less likely. So you can see they're in a catch-22 situation. So is it any wonder some of them are now starting to sit on their hands? If we now jump to Brexit, one of the other big themes that we've had of late, the pound has continued to rally higher. Now we've gone up as far as $1.25 on the pound, and that's partly because Boris Johnson's being frustrated by everything he's trying to do, and a potential delay in Brexit is looking increasingly likely. Now that is the pound rallying even though inflation has come in lower than expected. So right now investors are watching what the pound is doing, because it is starting to impact their portfolios. We've had quite a rally of late. So overall, the message this week is the narratives are flipping back and forth, and investors are not sure where we're headed next. They're not sure if the bond collapse is going to continue, or whether treasury yields are going to start falling again, and are defensive going to start picking up again, or is it going to be some of the more value stocks that we've seen in September, at the beginning of September, that have done well? Banks, for example, will they start to or continue to rally? So at the moment, we are in an interesting space with the investment markets, and perhaps worryingly, there are some parallels going back to last year in the autumn. And don't forget what happened at the end of the autumn last year. Of course, in October, stock markets tumbled. So that is it for this week on Damien's Midweek Markets. If you want to get in touch, you can do in the usual way. Contact me via email, damien@moneytothemasses.com. On Twitter, it's money2themasses with the number 2, and of course you can find me on Instagram, and make sure you subscribe to our YouTube channel.